Mark, we come in, we've had a nice long break, we had an opportunity to read lots of things and figure out exactly where we are, but the problem is I'm not sure we're much clearer, and the data are making it more complicated.
I think we are clear. It's just that we're all looking for the scenario that's not happening. We are clearly in a no-landing bull market, and we've been there since the December Fed. That was where Powell basically repeated the errors of 2021, and I heard your conversation there. He's definitely more Burns than Volcker. He was too dovish in 2021, and yet he insisted he didn't want to do that. In December, he's again been way too dovish when the economy did not yet justify cuts. And so therefore, saying that he wants to cut as soon as possible when the economy is strong, when the economy is hot, is just going to lead to another inflationary move again. At the moment, I think the narrative is very clear. It's a bull market for risk assets from the macro side right at the moment. I don't see that change any scene. I don't see any catalyst to change that. And I think the reason that we don't have any clarity is because too much of the world is desperately looking for a negative catalyst that hasn't been on the horizon since December, and I don't see it right now.
Does the shock come from is the shock an equity market shock, though, when it arrives, though, or is it a bond market shock? Is it this realization that actually rates are not going to move? Is that where the catalyst comes from? If the 10-year gets to 5%, if the 10-year pushes beyond that, if the dollar continues to strengthen from here, do other assets other than equities ultimately cause the shock for equities?
I'm not seeing it. I think we're going to get short-term volatility when people realize, hey, the Fed may struggle to cut it all. I don't know why we're debating about whether it's 50 or 75. They're not going to cut 50 basis points. The only reason they'll be cutting 50 basis points or more, and I say even 50 basis points, is because there's an economic crisis out there. I'm just not seeing it on the horizon. I think that every time we get yields higher, then obviously that short-term causes stress for equities. But they're rising because the economy is strong, and that is good for the stock market. It's good for earnings. Consumers still spending, so the shock does not come from the bond market.